In this lesson, you're going to learn how to complete the cost of equity calculation for Apple, and then how to finally arrive at their WACC, their weighted average cost of capital, at the end of this analysis. Now, we've already been through the basic concept for cost of equity several times in the last few videos here, so I'm not going to repeat everything, but just to recap the high-level view here, with cost of equity, we want to look at the risk-free rate plus the equity risk premium times the adjustment factor, which in this case is beta. So we're looking at how much an investor could earn with relatively risk-free investments, then adding the expected return over those risk-free investments, and then adjusting for company-specific factors here. So the first calculation I'm going to make is cost of equity based on the comparable companies. And for this one, we're simply going to take our risk-free rate from above plus our equity risk premium right here, and we're going to multiply based on Apple's levered beta right here. Remember that this is coming from the median unlevered beta of the comparable companies, and then we're adjusting it for Apple's capital structure here. In this case, it doesn't really need any adjustment, but nevertheless, that's how the calculation here works. So we get to 12.5%. The other thing we like to do here is also look at cost of equity based on Apple's own historical levered beta, because remember that we don't technically have to go through this calculation. We could just take Apple's existing levered beta and use that as well. And usually these numbers are fairly close if we've done our calculations properly, but we like to look at this as well and then select which one we're going to use. So if we base it on Apple's historical beta, we would go up to the top, take our risk-free rate, add our equity risk premium, and then multiply by Apple's historical beta right here. So you see in this case, the comparables one is lower by about 3 percentage points. This is actually a fairly substantial difference. Now in this case, we could really go with either cost of equity here in our WACC calculation below. Most of the time in investment banking though, you go with the cost of equity based on comparables, simply because data from 5 companies here is usually viewed as better than data from a single source, from a single company. So we usually go with this one. Now, if there's a specific reason that the historical beta is more accurate here, so let's say, for example, that our data for the comps is not as good, that we don't have really good comparable companies, then maybe we would go with the historical beta instead. But in this case, I'm just going to use cost of equity based on the comparables. So the actual WACC formula here is no mystery. It's simply what you see right here. Cost of equity times the percent of equity in the company's capital structure plus cost of debt times the percent debt in the company's capital structure times 1 minus the tax rate plus cost of preferred stock times the percent preferred stock in the company's capital structure. In this case, we know Apple has no debt and no preferred stock, so those last two parts don't even really matter. Nevertheless, I'm going to go through the entire calculation here and show you in Excel how we actually make this calculation for WACC. Remember, the idea behind WACC is that we want to look at what the average investor in Apple, in all of its capital structure, could expect to earn on their investment. From the perspective of Apple, it shows them overall, on average, how much does capital really cost? How much does it really cost to run their business and to fund operations and to get capital from all these different sources? So the formula here is our cost of equity. For the percent of equity in the company, we're going to take our equity value right here and divide by equity value plus debt. If we had preferred stock, we would also be factoring that in. So that gives us WACC, the cost of equity portion of WACC. Now for the cost of debt portion, we're going to take our 9% interest rate on debt right here, and then multiply by the percent debt in their capital structure. So debt divided by debt plus equity right here times 1 minus the tax rate right here. And we know here that Apple has no debt, so it's no surprise that their cost of equity and their WACC are actually the exact same number. Now I left out the last part here for preferred stock because we don't even have an entry for that. Even in our 3-statement model, we don't really have an entry for this because Apple just has nothing in the way of preferred stock. We don't even know what interest rate or dividend rate to use for this preferred stock. So in this case, WACC is simply equal to cost of equity because the company has no debt. And this is actually a good rule to keep in mind when you're thinking about WACC and using it in a calculation like this. If a company has no debt, then WACC and cost of equity should be the same. But that is how we actually make the calculation here that lets us get to Apple's weighted average cost of capital. One final thing we want to do here is go back to our DCF analysis and make sure our discount rate is now linked to the WACC number here at the bottom. We see that with this in place, our implied price per share drops by around $20 per share. So overall, the valuation here is quite a bit lower because our discount rate is higher, so you'd actually expect this. Whether or not the valuation falls or rises depends on what the discount rate does. If the discount rate goes up by calculating it more accurately, our valuation will fall. If the discount rate goes down, then our valuation will rise because we're discounting the money by less. So now you have an understanding of what WACC, weighted average cost of capital, actually means, how we look at the individual components, cost of equity, cost of debt, cost of preferred stock, and then how we factor in everything, unlevered beta and relevered beta, to finally arrive at Apple's cost of equity and then their WACC here at the bottom of the page. With the conceptual understanding and the understanding of how we actually make these calculations in Excel, what we're going to do next is go over some common interview questions on the topic of cost of equity, cost of debt, cost of preferred stock, WACC, weighted average cost of capital, levered beta, and unlevered beta, and related topics. And we'll go through how you can effectively answer these types of questions in investment banking interviews.